Yes. Yes. Okay. Good afternoon. My name is KETTERI NÅMM. I'm very excited to be here, standing in front of you at this conference, representing Bondora, a fintech company that we both work for, and I work there as a head of outreach. So yeah, and let me start off by saying today the line dividing banks and peer-to-peer lenders is blurring. We are currently going through the biggest changes in financial industry, the rise of fintechs, and it's going to transform banking as we know it. But the ones who will be most significantly impacted by the rise of fintechs are those who work in the financial industry. That's you guys. The bankers of the future will be very different than the bankers today. They will be different by skill sets, values, and personalities. And what we want to share with you today is what is even P2P lending, what are the different types of peer-to-peer lending, what are the benefits and risks for investors as well as for borrowers, what are the challenges for P2P fintechs, and I really hope you stay until the end where we share you a little piece of Bondora story, also lessons learned and affiliate marketing program. So on that note, I will hand over to Matthew CLANNACHAN, who's a colleague of mine in Bondora and as well the business owner of Investor Platform.
Thanks, Ketteri. So I'm going to move this on. Right, so maybe some people in here know what peer-to-peer lending is, maybe you don't, but as a concept, so it's this way of lending money, receiving it as interest or as an investment. It's been around for thousands of years. This isn't actually anything new. But the past decade has seen this become available to normal people like you and me. So prior to this, and specifically prior to 2008 actually, the lovely logos that you can see in this picture is probably who you had to be a part of, or one of the people that you had to be a part of to be able to take part in this asset class. So for example, you would have to be extremely rich, you might have to have some connections to be able to take part in the consumer credit market. Now, in the past decade, this has become available to the average investor, and depending on the platform, you can start from a really, really small investment to actually take part. Now, for more specifics on actually how it works, so this is really useful for you to see actually who is benefiting from this. So the investors, the borrowers, and then there's an intermediary in between who does all the legwork for you. So it means that you as a individual person, you don't have to get any credit licenses, you don't have to go through any of the authentication process, you don't have to individually score people. This is actually done for you by a good platform. So as an investor, you would be looking to diversify your portfolio through your investments, and you can do this in a number of ways which we're going to talk about in a moment. And in the meantime, we make sure they're a legitimate person, we avoid fraud, we make sure the support is there, we take care of all the after servicing as well. And so what this means for you is that you don't really have to do much work, which is good. And for the borrowers, they actually get low interest rates, they get a competitive service, everything is online, and the repayments that they make on their loans or credit, whatever kind of finance they're getting, comes straight back to you as the investor as well. So it makes the world of finance democratized. It makes it accessible for everyone. Now, if you haven't heard of it, this kind of puts into perspective actually how big this is at the moment. So you have all these different platforms, many in Europe, many across the southern hemisphere of Europe, and also North America now as well. The biggest one and the first one actually being Lending Club, which was established I think around 2005, followed by Zopa and also Bondora in 2007 as well. So this is really global, and once the trust gap in this industry, or the knowledge gap, is bridged, which again we'll touch on in a moment, you'll see that this becomes more commonplace than people just holding their investments and their trust in just their bank. So the traditional type of crowdfunding, which you might have heard of, especially if there's any entrepreneurs in the room, is crowdfunding for a startup business. So you've heard of Kickstarter and those kind of platforms where you tell people your idea and then they can invest in this for a piece of equity or something for the profits that you make when the business is actually legitimized. Now, you could say peer-to-peer in the form of an investment is a form of debt crowdfunding, you can call it. So to actually partake in this and what they actually issue these investments in, this lovely picture here will show you for any property investors in here. So if you want to invest in any commercial projects, any maybe individual residential projects, traditionally you'd have to do all the viewings, the valuation, the financing, everything yourself. But these platforms are making it possible for you to have a small share in a huge project, which again you wouldn't have access to more than 10 years ago. Another form is for business loans as well. So Funding Circle, you saw on the map previously, really popular now in the UK and across Western Europe as well. So funding small businesses for the people who maybe they want to start a cafe, maybe they want to start up some innovative tech platform. Now, in a time where bank finance became very restricted, again post-2008, there was a real need for this because businesses are required to jumpstart the economy again and bring back the power to the individual. So platforms like this are fantastic for actually giving people that power back. And on the more personal level, if you look at it from a family's point of view, and something that we actually do at Bondora, so we issue private loans to private individuals, and they can use that for getting their dream holiday, a car, maybe doing some home renovations. So this really touches everyone from all different walks of life. And I'm going to hand this back to KETTERI now.
Yes. In B2B platforms, on one side of the transaction are the lenders, we call them investors. And what are the benefits for investors? Well, first of all, investors are seeking diversification and growth opportunities. So that's what B2B platforms are easily offering them. Investors can earn a return while managing risk by allocating their investment between like dozens or hundreds of borrowers of different credit rankings. And also what's good about B2B platforms is that it gives them proprietary credit models. It also gives them trust, safety, automated options, and as well as no need for any special licenses. At the same time, with each investment, risk is involved. So it includes the transparency and accessibility of public data, the company's financial performance, the global financial recession, and that the platforms are relatively new to the market. On the other side of the P2B platform transaction are the borrowers. Borrowers are looking for speed, quick decisions on their loan applications, also fair scoring, and at the same time comfort of doing it without leaving home. And that is exactly what P2B Fintechs are striving for in their service offering. Also for borrowers, there is also risk involved. And it includes as well relatively young platforms, no physical presence, sometimes too much choice, and less trust than banks at this point. However, with millennials becoming the largest group of investors globally, the trend is changing in favor to fintechs.
So something that I touched on 5 minutes ago was bridging this trust gap, and something KETTERI just mentioned as well. So as it's relatively new, the whole peer-to-peer fintech platforms are relatively new to the scene. You could say there is a trust gap, which people say, okay, do I really want to invest in a company out of Estonia, you know, if you live in Germany, or do I want to invest in a platform out of Italy if I live in the UK? Now, at the moment, there still might be a bit of well, hesitance towards that. And I think it's purely just this element of trust, because once you trust a platform or your local bank, you're happy to let them handle your money, because obviously it's probably one of the most important things to people. So a lot of people complain about their banks, but highly likely that because they have a physical presence, you can go there, you can meet the store manager, you can meet the advisors, you can tell them about your day. It's likely that you'll have a lot more trust in them. So over time, this will change, and we can see it is already changing now compared to 5 years ago. And it leads on to the next point of a continued track record. So again, investing in a company or a fintech which has only been active for a few years might make you, again, a bit hesitant. But if you can say, a 10-year track record, paid this much interest, had this many investors for this period of time, is a profitable company, okay, and then we can move with that and we can go with that. With the banks, a common misconception, I think, as a challenge, or maybe you will see this as a challenge, is banks are continuing to develop their technology. Now, people think that this means that, okay, then the smaller fintech companies can't compete with this. But actually, what it means is because the banks have the larger market share in pretty much every country, this means that they are leveling the playing field, because they're saying, okay, our customers now have to do everything online. Our customers now have to adapt the tech that you've been trying to get people to adapt to for the past few years. So once the knowledge gap in that sense is bridged, where your grandma who lives in the countryside is doing all of her internet banking like it's normal, then why can't they move to a more innovative fintech platform that is smaller than your bank as well? So a bit about us and what we do. The reason for saying this, is quite good to bring a case study to life, so you can see actually what one of these fintech platforms are like. And obviously we're probably a bit biased towards Bondora. So to date we have over 42,000 investors. They come from all around the world, but mainly in Estonia, Germany, the UK, Switzerland, and Austria. And we can see for all the affiliates in the room, you probably know in Germany there's a huge investing and personal finance culture, where people will document their experiences, they'll share images of their accounts, their progress, and it's led to one of our biggest investor bases coming from the country because of trust, again. Now, again, to date we have over 150 million invested in the platform and issued in loans out to borrowers as well, and 20 million has been paid back to investors. So again, as an affiliate, this makes life a lot easier for you if you're trying to explain to someone and trying to get across that element of trust again. So something that related to investing is that people think it's extremely complex. And usually when you hear the word invest, you kind of think, okay, no, not for me. Stocks, no, you've probably got a friend or family member who's told you, don't invest in property, this has happened to me. But what we've really tried to do is remove that element and make everything really, really simple. So whether you're an 18-year-old student who's completely new to this world, or you're retired and just looking for a way to earn some extra money, we've created a product called Go and Grow, which is the most simple way to invest in the world, in my opinion. Now, what this is, it's just a way for you to get a fast liquidity, so a limitation of peer-to-peer, because you issue your investments to other people, whether that's through real estate, whether that's through personal loans, whether that's through business finance. The money is with those people, so you can't just withdraw it and take it back. So that's been a limitation so far, because not everyone wants to lock away their money for a long period of time to earn a good return on their investment. So instead, we've created a product where you have a fast liquidity, so there's no need to get all technical when you need to come to withdraw. And also a benefit, because there's no unified regulation at the moment across the European Union for peer-to-peer investments. We've created something which is tax efficient, which I won't go into too much now, but happy to talk about after if anyone wanted to know. Back to you.
Yeah, so now that Matt addressed all the successful parts of our story, I would also, some of you actually might question, how did we get there? And well, let me tell you, 2 years ago, things were different. At the time, we had a hypothesis that why try to impress private small investors when you can impress whole big institutions at the same time? We had an impression that the real value lied in institutions. With that mindset, we had our product that we put our hearts and efforts into trying to impress the institutions while putting very low effort to cater for private investors. And guess what happened after the product launch? We managed to piss off all the private investors, and at the same time we were trying to grab onto the institutions so desperately that we actually built a completely new workflow each time a new institution came to us with their special requirements and special needs just to make our ends meet. So after times and times of rebuilding the workflows, we finally got to a point where we understood that the business model is not scalable like this. And a big shift needs to be done in order to improve things and to win back the trust of private investors, which was completely lost at that time. So the damage was done. And what did we do? We started from scratch with the help of the people who would use the product the most, the private investors. And it took a long time for us to win back their trust. So what is our takeaway from this experience? One very important question you always need to ask is what happens after the product release? And the lesson learned from our experience is that you always need to involve your network to the development process of your product, because only that way they will be more likely to use it and promote it in the future. That means including your customers' needs, talking to your top affiliates, making sure they completely understand the product, giving them tools to talk about your products and to introduce your products to their network, and pay your affiliates on time, and most importantly, keep the relationships. And on that note, I have a proposal to all the affiliate marketers here. If our presentation and company appeal to you, then please do and join our affiliate program today. Referring Bondora with your unique URL gives you 5% of the amount invested in the first 30 days after registering. It is a generous offer and so far proven to be successful for both our platform as well as for affiliates. So if you're interested to know more, you can just come talk to us during the conference. And with this, go check out our website as well. And thank you for having us.
Cool. We'll stay for any questions. Yeah.
Any questions from the audience? Yeah.
Hello, I have a question about risk assessment. How your company does it for the borrowers, for example.
Yeah.
And do you use something or plan to use something like blockchain for the future for such things?
So at the moment, we have our own proprietary credit model. Now, this rates a borrower based on how likely they are to default on their payment. So the range actually goes from AA to another 8 ratings below that to HR, which is high risk. So if you are using one of our tools to invest, you can set your risk profile of how much risk you're willing to take, and a basket of let's say AA to B rated loans will be put into your portfolio if you're looking for something lower risk, and if you're looking for something higher risk, then it will do the opposite end of the spectrum. But specifically what we actually do, we do the traditional methods of income, outgoings, address history, but then we look at more non-traditional data as well, so actually how they use our website, how long they spend on our website, social media, combining this with education data, home ownership, everything. And it's all done online, and the reason that we can do this is because the markets that we operate in at the moment are only where we have our borrowers who can connect via their ID card like you have in Estonia. So all this data is then transferred immediately to us. It goes through our proprietary model, and then it gives them an instant decision. So it works for both parties because we understand nearly instantly how likely they are to default on their payment. But then for them, they get an instant decision as well. So I hope that answers.
Okay. It means if the percent, you mentioned this A++, for example, rating, so the better rating, the smaller is the interest, I guess.
Yes.
Okay.
Yeah, so it will depend. So let's say if at the riskier end of the segment, those borrowers will be charged a higher interest rate because we expect more of them to default. And if they do default, the remaining part of the portfolio will compensate for that because of the interest rate. Yeah.
Okay, thanks.
Any more questions from the audience about P2P? Okay.
Hello.
Hi.
The citizens from a lot of countries can take part in this borrowing money from you, and how do you handle with the differences in legislation of different countries?
So our borrowers actually only come from Estonia, Spain, and Finland. At the moment, we have no plans to expand further, but they are the only markets that we operate in. So it started in Estonia, and then we moved to Finland, and then Spain after that. In terms of regulation, because we only have offices in Estonia, we follow the AML credit directives of Europe, and also KYC as well. But we connect with local agencies there, the local credit bureaus, to get the data from them. So the legislation for us to operate as a credit provider, you don't actually have to jump through a huge amount of hoops to actually set up. But to do it correctly, it's very difficult. But to actually get set up, it's not too restrictive for companies to lend in, if that answers your question.
Yeah.
Maybe, yeah.
Thanks.
Hello, it's me again. So basically, I'm from Credit Plus, by the way. We are operating on the Russian market, and we are we are a microfinance organization. And my question is kind of related to this topic. So you mentioned the banks as the main competitor of yours. So do you consider microfinance organization who are shifting from like payday loans to different type of loaning as competitors as well?
The short answer is no. And just for the reason, if you actually look at the market share of companies like Bondora itself, companies like Bondora, microfinance providers, the share per country compared to the banks is extremely small. So conversations that I've had with other P2P platforms has actually been to share best practices within this environment to make the industry more trusted itself, and whether that's through traditional peer-to-peer or with microfinance loans as well. But compare in any country in Europe, and I guarantee you the share of companies like ours compared to the biggest bank in the country is minuscule. Yeah.
Thank you.